Welcome to Markets Today with your market strategist Gaurav Kashyap. Well, we saw that dollar strength continued through the US closing yesterday and through the Asian and European opening today on the back of a much stronger than expected US retail sales figure released yesterday. Data showed that month-on-month US retail sales in July grew 0.6%, higher than the expected 0.4% and well above the previous June reading of 0.3%. It was the biggest gain since December 2016. Core retail sales less automobile sales, grew to 0.5% actual versus an expected 0.3% and well above the previous reading of 0.1%. Retail sales is a key component of consumer spending, and of course consumer spending is a key component of overall US GDP, and the stronger beat no doubt sparked optimism around US future growth prospects. However, we would take the retail sales data with a pinch of salt, as motor sales surged 1.2% last month. It was the best performance since December 2016, and it was on the back of record incentives provided by US automakers. Following the release, there was a little movement in the CME's FedWatch tool, which is the barometer which measures the market's expectations of future Fed rate hikes. The dollar index rallied following the release and peaked at 94.04 levels, where it is currently finding resistance in today's trading session. Earlier in the morning, we had the release of the private API weekly crude inventory stock data, which showed that there was a massive drawdown of more than 9.2 million barrels in crude stocks last week. This was well above the estimated drawdown of 472,000 barrels. Crude held at our level given yesterday at 47.00 and immediately found a fresh wave of buying following the API release. Expect the volatility to pick up in crude at 14:30 GMT today with the release of the weekly EIA crude inventories report, and this report is expected to show that inventories dropped 3.058 million barrels last week. We expect the WTI crude contract to find support at 47 levels again today, with resistance coming in the channel between 48.40 and 48.60 today. Also releasing today was the UK jobs data, which showed that the overall unemployment rate in the UK dropped to 4.4% actual versus an expected 4.5%. The claimant count rate also suggested strong gains in the UK labour market, and more importantly, the average earnings also beat expectations at 2.1% actual versus an expected 2.0%. The data was good enough to see a fresh round of buying in the GBP USD cross. However, I feel that this is a short-term blip, as the overall bearish sentiment in GBP USD is set to continue through the rest of this week. We saw the GBP USD cross break through our downside target of 128.60 given yesterday, and we expect the support to come in the same channel between 128.20 and 128.60 today, with upside resistance coming at 129.40 levels. Like the British pound, the euro has been under pressure since the start of this week. The euro USD cross was able to par some of its earlier losses in the Asian session after euro area GDP came in much better than expected. Data showed that the euro area GDP grew to 2.2% year on year, better than estimates at 2.1%. The euro USD, as a result, popped above 1.17 levels where it's currently trading. However, we expect some downsides through the rest of this week. And finally, guys, also releasing this evening is the FOMC meeting minutes, which is due out at 1800 GMT. The minutes could see a fresh influx of dollar buying, especially if the FOMC language hints and reaffirms the views of 3 rate hikes in 2017. So keep an eye out on how optimistic the FOMC language will be in this release. Guys, if you like this video, please give it a share, and if you don't already do so, please give me a follow on Twitter at EGM Futures. Have a great day of trading, guys.